We talked a lot about rents, perhaps not quite hitting the mark. How do you see, from your perspective as an office leasing negotiator, how do you think the rent growth situation will pan out in 2012, and also what will incentives do?
You're looking across the board and you probably say it's going to be steady as she goes. I don't think we'll see any significant growth across most of the office markets in Victoria this year. That said, I think from a renewal perspective, we're going to continue to see some fairly significant rental increases on the prime front. We are seeing a lot of market-leading incentives in order to finalise transactions. That said, I think we're going to be capping out very soon, and we're hearing of incentives in the mid-20s, but I think that'll be the end of it. I think later next year we'll start to see that tighten, more to the point where we will start to see into 2013 effective rental growth.
Mm-hmm. Okay. Well, finally, one issue in the industry that always generates a lot of discussion: tenant reps. What's your view about tenant reps and their future in the industry?
That's a loaded question, Kevin. I mean, they're an integral part of the industry. I mean, you saw on the slide previously that they bought out, I think it was around 129 briefs in 2011, and that totalled over 320,000 square metres of office space. Mm-hmm. So yes, they are an integral part of the industry. They bring a robustness to the process and a sophistication in their understanding of the tenant's requirements. That said, and drawn back to that value-add process, I think we've got to go above and beyond the tenant rep briefs and find opportunities outside of that market.
Okay, great. All right. Well, thanks, Chaz, and good luck for the year ahead. Let's move out of the CBD now and talk to Justin Clarkson, who works out of our South Yarra office in the investment and leasing side across the suburbs. Now, sentiment, of course, has moved very harshly against suburban office right around Australia. Justin, what sort of impact are you seeing that have on deal flow and pricing?
Well, definitely impacted in 2011 in terms of the number of deals. The deals over $10 million in the suburban office market last year was a count of 3, which in previous years was dwarfed by a lot higher number. I guess what we're finding is the unlisted groups that were very active in the market 4 or 5 years ago are no longer players. So it's very much driven by the private sector, syndicated coming back in the market, and we've got some interest out of China. So we'll probably see some more turnover in that space in the coming year, but I see it as a real opportunity because there's a lack of depth in that market. What's been holding up the market in the office sense is really the turnover stock at around sort of $5 million. That's largely driven by the private sector, both from the vendor perspective and the purchaser perspective, and the values have been held up quite well, and there's good turnover of stock, and there's quite good sentiment in that space. There's probably a third tier of the market that's probably Mark Costa more deals than myself, but the higher end, over $50 million government lease type scenarios where there's been a number of commitments, and the overseas interests are being shown in that sort of property across the board, and some privates will probably get priced out of the market.
Okay, so it's interesting that suburban office is showing some parallels to the industrial sector in that there's been quite a rapid decline in construction activity as well. So how does that relate to the leasing market? There must be still some demand for tenants to move around, or even though there's perhaps very little organic growth, still tenants moving around the market must be finding it hard to satisfy their requirements.
Well, 2011 was a great year from a leasing perspective, particularly for larger deals. I think Richard Height got up here last year and forecast there was going to be 4 pre-leases done in the outer eastern market, and there was in fact 5. So that's a really good story for that outer eastern market, and also equally the inner eastern market, the Hawthorn-Camberwell market. There was 5 deals over 2,000 square metres concluded, and Bennelong were the big winner in that particular environment. They had 12,500 square metres of space taken up in 3 buildings across that Camberwell-Hawthorn market. In terms of requirements, the main requirements going around in the market at the moment are mainly government tenants. South East Water have a 10,000 square metre requirement in their catchment area, which is very broad from Moorabbin to Hastings, and they're currently in the shortlist process at the moment. And more specifically, the Dandenong Tax Office are relocating from their old building for 15,000 square metres on a specific site adjacent to where they are at the moment. And that follows on from the 20,000 square metre commitment for the Tax Office to relocate in Box Hill across the road in Whitehorse Road. So that's where we're seeing it, mainly government driven.
Well, I mean, the other interesting element, we said in industrial that we expect rent growth could actually jump fairly quickly because of that lack of supply over the last couple of years. I mean, are you seeing a similar thing in suburban office?
I think the general trend in suburban office, probably unlike CBD, is rents up, incentives down. The skilled deal, which was done in Hawthorn last year, one of Bennelong's buildings, the incentive rate there was under 8%. So that goes to show there's a real pent-up demand, for particularly for larger tenants who don't have the options if they want to get in that, specifically that inner eastern market. The outer eastern market's a little bit different because there's more land supply and the ability for pre-leases to occur in that sector.
Okay, so the sites available for development, one of the issues we've noticed in the last couple of years is that residential has tended to be taking over from commercial as a use in suburban office markets. Do you see the two still sort of in competition with each other, or is it tilting back more toward commercial now?
I don't think there's any doubt there's still demand for boutique residential development sites, particularly with permits or without permits, who have the capacity for about 100 apartments. Any bigger than that, the demand really drops away, although there's some interest from Asia in that sector. But what we're probably finding is the pendulum swinging across from residential to commercial. There's been a few examples of sites that could be either developed for residential purposes or commercial purposes have actually gone down the track of commercial. As an example, in Riversdale Road, Surrey Hills, where that particular developer owned the site for 4 or 5 years, had a residential scheme, it was actually spec'd a 2,000 square metre office building, and I suspect that will be leased up probably before it's completed.
Okay, so you know, by wrapping up now, where do you see the sort of key opportunities in the year ahead in your sort of outlook?
I think there's probably two major opportunities. One's from a development perspective, particularly in the eastern market. I would suggest sourcing sites that have the capacity for commercial development. They could, preferably with an income, you could perhaps get a permit for an office user and then wait for the tenant to come to you. And the other option, in terms of the investment perspective, is really that $20 to $40 million investment space in the suburban office sector, where there will be more stock come on the market this year, but there's really a lack of buyers in that space, and potentially there could be some opportunities to buy quite well because the banks are hovering in a lot of those cases.
Okay, terrific. Thanks, Justin. Let's now move into, as I mentioned, in some ways an allied area of the market in the Metropolitan area, to industrial, another new kid on the block, Dean Hunt. Dean, we've seen this situation where construction activity in industrial has dropped quite markedly, yet the demand seems to be continuing to grow. So what's going to come out of this situation?
Well, construction rates have dropped, and that's really seen a direct result of A-grade property and A-grade space being reduced. And then compounding that, we've seen container rates increasing. So there's really a huge amount of pressure sitting on that existing supply. So out of that, we're starting to see two sectors really emerge, that spec market and also that pre-commitment market. So we sat here last year, we talked about the spec market starting to return, and we saw groups like Australand starting to do that in different areas. Last year, we then saw Dexus join that group, starting to focus, yes, on those 10,000 square metre plus type facilities. This year, I think we're going to start to see the emergence of that smaller private syndicated market, which is going to start to bring forward some of the smaller spec product, you know, about maybe sort of 1,500 to 4,000, about as big as they'll go. And then looking again at the pre-commitment market, occupiers who need not even hugely specific product, but product which is to a certain grade, they don't have a lot of options. So we're starting to see that really emerge and starting to see a lot of briefs coming to the market. And that really, we're not seeing a trend like quite as strong as what Chaz is with tenant representation in commercial leasing, but we are seeing tenant representation starting to build more momentum. And I think that activity and that reduction in prime stock is certainly going to encourage that